Hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Today we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Well, hello everyone, Chad Frantzen here, and welcome to the Kingdom Finance Show. Hey, today we're going to pick up where we left off. We're going to continue talking about the 2023 economic outlook, and this will be part 2. So if you haven't already listened to part 1, please go back and listen to that episode. Today, what we really want to talk about here is we want to talk about this concept about recession and what it really means. And as we dive in, feel free to reach out to us online if you want to learn more about our investment philosophy and getting connected with our team of advisors. You can go to wealthbuilders.net/invest. That's wealthbuilders.net/invest. So let's jump in. We're talking about the economy and the outlook for 2023. And really, we have this R word called recession. And I want to spend a little bit of time just explaining what causes a recession. And a recession tends to happen because of one of a few different catalysts. The first is an overheating economy. In fact, most recessions occur because the economy, in effect, demand grows so fast that supply cannot keep up. And that, in effect, equals an overheating of the economy, kind of like the engine on your vehicle overheating. When demand outstrips supply and employment capacity, then you have such a high demand that you have this concept called inflation. And I think everyone, even a fifth grader, knows what inflation is. It's a household name in my family because even our toys and our Legos, now inflation has hit them, and Legos cost more than they used to. And believe me, the kids know. So a great teachable moment for those of you with kids or grandkids around you on what inflation is. Historically, inflation is around 2 to 4%. The U.S. government would like to see inflation get back down to around 2.5%. And right now we're coming off the heels of having it as high as, at least at the government reported level, 8+%. It's trending down right now at the moment. So we'll see kind of where that goes. We talked about that in episode 1 and what our thoughts are on what we refer to as a double dip inflation. So overheating economy, 1. 2, what else can be a catalyst for a recession is what we call a bubble and a asset bubble. And we've talked a lot at some of our wealth builder conferences about an everything bubble, an asset bubble. And when we think about prices of things, particularly in the capital markets, this concept of bubbles is when prices become so out of whack, they're so beyond the median of what they are over a historical time frame that it becomes a bubble. And so we see that like in the early 2000s, we saw the dot-com bubble. We saw a lot of irrational exuberance around that. We've certainly seen really high prices in real estate as we came out of COVID. And we've also seen that in the stock market, in the bond market, certainly in cryptocurrency, we see that. So when a asset price gets driven up by speculation, euphoria, an overheating economy, those prices are not sustainable. And so we refer to that as financial gravity. So the concept of financial gravity is, as it implies, what goes up must come down. And that is true if I threw a rock up in the air or a baseball. And it's also true when we talk about the prices of real estate, stocks, bonds, and commodities. We certainly saw that with the housing market back in the recession of 2007 to 2009. Those are 2 examples of financial bubbles. The third way a recession can be caused is some type of an economic shock. And I often refer to this as a black swan event. So something, whether that's Russia invading Ukraine, whether that's China invading Taiwan, or whether that's the COVID-19 pandemic, right? You have some type of black swan event. Certainly in the 2007, 2008, we saw companies like Bear Stearns and AIG file for bankruptcy, which was a huge shock to the system. So that's the third way that a recession can happen. Now, a common question we get at Wealth Builders is, well, how long does a recession last? I understand there's some things I need to do to prepare for it, but how long should I expect them to last? Well, it depends. It's a really good question. And statistically, the average recession in the U.S. going back to 1854 has lasted about 17 months. Now, since World War II and what I will call the modern era of economics in the U.S., the recessions have lasted a little bit less, approximately 10 months in the United States. Now, you can have much longer recessions, such as the Great Recession of 2007 to 2009 when we had the financial crisis. That recession, for those of you who remember, it lasted actually 18 months. But we look at the COVID-19 induced recession that happened in 2020 in March and April, and statistically, that only lasted 2 months. It was a very quick recession, primarily due to Federal Reserve authorities creating money for commercially zero interest to get things going. So a recession's duration does depend on a lot of different factors. It's often dependent upon how the Federal Reserve in the United States responds to it. So again, the takeaway here is recessions can be shorter or longer, but now we believe we're heading into a recession in 2023. It's likely parts of the economy are already experiencing it. I'm going to get into that a little bit more. Again, we talked about this on the last episode, but interest rates are not fully felt in the economy at the level of a small business owner or a consumer until 6 to 9 months after the media announces, hey, the Fed raised rates today. Well, that's really important to know. Now, when we think about the recession, our view is that we do feel the recession will start in Europe and Asia. We're going to see it more pronounced there before it hits the U.S. The U.S. economy, we're recording here in January, latter part of January 2023, heading into February of 2023. The economy is still very strong in the U.S., and we're going to talk about that and how that's going to impact interest rates having to keep going up. Now, let's connect some dots here. When we think about the recession, we understand what are some catalysts that can cause it, what's the average length or duration of a recession. But let's talk about how can a recession impact your money. And so I want to give you some statistics on the stock market. And I'm going to use the stock market because it's a really good barometer for all other asset classes, whether that's commodities or real estate. Stock market is a really good barometer for that. So the stock market at a high level tends to lose, on average, about 1/3 of its value heading into a recession. Now, today, the stock market is certainly off its highs. I don't have the exact numbers, but it's certainly not off 30% from its highs. It's actually been pretty resilient in what we call a bear market rally over the last 5 to 8 weeks, which has helped a lot of bullish stock fanatics. And so heading into 2023, we're not down 30% off the highs. In fact, we're not anywhere near that. So we call these drawdowns. And so the drawdown on the stock market, and we look at the S&P 500. Now, that's the 500 largest publicly traded companies in the United States. They're a really good barometer for the global economy. So whether you're investing in stocks or not, it's just important for you to have an education on that. So the S&P 500s during a recession, heading into a recession. Now remember that the stock market is a predictive indicator of where the economy is headed. So the volatility we have seen in 2022 and the stock market volatility we anticipate to see here in 2023 is telling us the bell is starting to ring that the economy is headed for some chaos in hard times. Now, these drawdowns in the stock market have varied from as little as 14, 15% drawdown all the way to as much as a 57% drawdown in the value of stocks. And certainly we saw that back in the 2000 dot-com era. Now, the average is closer to 32, 33% drawdown on that. So when we talk about managing money, and we're happy to visit with you one-on-one on this, you want to have a strategic plan for how you're going to navigate the recession, how you're going to navigate volatility in the stock market, because that's going to impact your mutual funds, your retirement accounts, even your real estate and your commodity holdings. So I hope that's helpful from that standpoint. One other thing I want to talk about, and in a future episode, we're going to talk about asset classes that we like. We're going to talk at a high level of some of the asset classes that do well during times of economic chaos. Again, we're real big believers at Wealth Builders in diversification. So we don't think you need to be going out putting all your money in one asset class just because Uncle Joe said or your buddy that you hang out with said to do so. You want to have a disciplined strategy for wealth management. One other factor I want to just share with you is what is called volatility. And there is a statistic for this called the VIX, V-I-X. And not to get too technical on this show, but just as we wrap up, the VIX is a measure for what is called implied volatility. And you can go out and you can look on Google or any type of financial website, and just like getting a quote for how much is a share of Tesla stock today, you can also get a quote for what is the VIX. And again, this is just a measure of volatility. It's not a company or anything, just to be clear. And, the VIX today is around 20. And traditionally, a number below 20 represents calmer conditions. So not a lot of waves, right? We don't have anything crazy going on in the capital markets. So if it's below 20, it's a bit of an all clear sign. And it means it's implying that volatility is pretty minimal over the next 30, 45 days. Now, the thing with volatility is it can change on a dime, right? You can have an economic report come out. You can have a black swan event. You can have a geopolitical event, and it can turn literally from Friday to Monday. Now, the VIX, as it gets above 25, that is saying it's an indicator that there is going to be an increase in volatility, right? So if you know these type of indicators, then it helps you when you're managing money. Now, just as a side reference, when we were at peak COVID in the spring of 2020, this measure of volatility, VIX, shot up all the way to 65. Now, that was unequivocally unheard of. However, so what we most often look at in managing portfolios, if the VIX is getting up, above 20, it starts trending to 25 or higher, it means we've got some choppy water ahead with asset prices. So I hope that's helpful as we talk about the economy. In summary, we do expect some continued economic chaos. Again, I want to encourage you, watch these government reports that come out on the GDP, the gross domestic product. Again, that's the pulse of the U.S. economy. Now, remember that you and I, as spenders and savers, we represent 2/3 of the economy: consumer spending, retail spending, travel and leisure, business spending. Right? We want to be aware of that. Certainly, our opinion is that the Federal Reserve will continue to raise interest rates in 2023 until something breaks. And as investors, we need to be mindful of that as we think about how to manage our resources through what we believe will be a very tumultuous 2023. Hey, I hope that's been helpful for you as we cover part 2 of our economic outlook for 2023. Again, 2022 was certainly a wild ride, both in the markets and geopolitically, and we expect more of the same. But we do want to remind everyone at Wealth Builders, we really believe that as we gain knowledge, understanding, and wisdom, that all of us can make informed decisions on how to be true kingdom impact investors in our community and around the world. Hey, thanks so much for joining us on the Kingdom Finance Show. And again, if you want to learn more about Wealth Builders, visit us at wealthbuilders.net/invest. Thanks so much. See you next time. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show.